My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make some money. My job's not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Sometimes you have to ask yourself, where is the money going? Right now, it's pretty hit or miss when it comes to consumer. Home builders like Toll tonight are seeing some good money flows, but retailers are spotty. Macy's, Urban Outfitters, and Walmart hit, but Lowe's and Home Depot, well, they miss. Not a lot of money flowing to retail. Instead, it's flowing from one business to another, or maybe from a government to a business. After a day where the Dow advanced 66 points, S&P climbed 0.25% to a new high, and NASDAQ also hit a new high, up 0.22%. We see that at this moment, this very moment, because of these money flows, you got to be investing in companies that don't cater to just the consumer, albeit with some rare exceptions, and instead zero in on those that make money off the enterprise, as they call business. And now I've long championed this market. I've truly gotten comfortable with many of the sectors, but consumer spending on hard goods just ain't one of them. And that's a big reason why Lowe's saw its stock get hit today. Marvin Ellison, the CEO of Lowe's, is on tonight's show, and he'll talk about a consumer who's on the sidelines, who just isn't inclined to start spending on big home improvement projects. Why? He sums it up pretty darn well in his conference call, and I quote, uncertainty around interest rate cuts, stubborn inflationary pressures, and a consumer still showing a preference towards spending on discretionary services and experiences continues to weigh on the do-it-yourself home improvement demand, end quote. Too many homeowners with low or no mortgages. Too many people who don't want to take out a 7% mortgage to buy a new house and then be underwater immediately. No buyers of existing homes. What that means, of course, no renovation. So what can change that predicament? See, that's the problem. It's why I am so uncertain recommending consumer stocks. What can change the predicament? I'm not sure. As Brandon Sink, the CFO of Lowe's, said, quote, we're not seeing that inflection point, end quote. And then he goes on, quote, we don't necessarily expect or understand the timing of that, end quote. If he doesn't understand, how am I supposed to get it? So for Lowe's and for Home Depot before it, the landscape's not so much bleak, it's just not that rewarding. And that's how both stocks could get hammered on earnings, because the consumer's not opening her wallet enough in the stores. In a sense, it's becoming almost a winner-take-all, loser-take-none situation, with the winner, at least in the big box segment, being Walmart, which puts through breathtaking same-store sales and deserves to trade higher than its current $65 level, even though to many it seems like an exalted post. But money doesn't stay in a cul-de-sac, people. It doesn't wait for something to happen. It gravitates to where the spending's going. So where's the money going if most of the retail area is a no-go zone, even though two-thirds of our economy is indeed consumer? Well, we know there are some big themes that seemingly just can't be stopped, and the biggest one is data. Any kind of data. The data that Lowe's collects from its loyalty program. The data that Target has from its store floor when it reports tomorrow morning. The data that gets stored in the cloud so it can be interrogated by employees and machines looking for patterns. Right now, just as there are individuals who aren't spending all that much to fix up their homes, there are companies that will spend any amount of money to build out their computing power, with much of that going to, yes, the data centers. In a way, it's unfortunate because retail is so easy to understand, and everybody shops. But unless you're a computer scientist, it's difficult to understand where that data is going, and it's even harder to figure out which companies benefit from the newfound corporate need for analytics, training, inference. For me, I like to keep things simple for you, okay? And the companies with the most data that can do the most data interrogating, Amazon, Alphabet, Microsoft, Meta, and to some degree, Apple. Salesforce and ServiceNow, they've got some data. They're spending millions, they're spending just billions, actually, on buildings that are filled with, yes, NVIDIA chips. Hence the anticipation for tomorrow night's quarter. Do you remember, I remember when I was the only guy thinking about NVIDIA. What the heck happened? Well, Jensen Huang was always thinking about it. He's the CEO. But now it's like NVIDIA. Like, people walk down the street and say, hey, how's NVIDIA? I hear him talking. They're like, hey, have you seen NVIDIA today? I mean, not to me, to each other. What the heck? Hey, let's talk about Eaton, Emerson, Vertiv. They make money, too. How about the plumbing? Marvell Tech, Arista Networks, Broadcom, Supermicro. NVIDIA. All right, did you see the action in Palo Alto Networks today, which we had on last time? At one point, the cybersecurity stock was down almost 24 points in wake of last night's quarter. Okay, 24 points. The stock cut that loss in half. At one point, it cut it by 2/3, finishing today down $12. Why was that? Because investors refused to hold off on buying shares in a cybersecurity company, not when businesses can't afford to stop spending their stuff because they got to protect their data. So you got to mine the data, you got to interrogate the data, you got to protect the data. Otherwise, it's going to end up like United Health Group, which is hit with a devastating hack that needed to be stopped but wasn't. I found it very telling today that CrowdStrike stock didn't get dragged down by a competitor. That's because its shareholder base knows how valuable CrowdStrike is to stopping the data from being hacked. They know that CrowdStrike's on a roll and its customers need it more than ever. The spigot from the tech titans to everything else, I don't know, it's just endless. You can't avoid it. Now, we've been stuck mostly talking about business spend, but lately we've been also getting signs that there might be another big form of spend with the consumer buying tech hardware. They're kind of just like, let's say they could be just sweetening things. I don't know yet, but we're now hearing from Microsoft about a brand new kind of PC that will replace most personal computers, one with an artificial intelligence co-pilot. The craziest thing is that even as Microsoft makes that pronouncement with such certainty, it hasn't meant much to the stocks related to the revolution. Okay, yeah, HP is up almost back to its 52-week high, but that 52-week high was back in July of last year when it was almost impossible to predict a new PC product cycle. Same with Best Buy, where you might be drawn to sample the AI-powered PC. Its stock is getting pummeled down to where it yields more than 5%. It's entirely possible that it'll take another whole quarter for the machines to get there, which is why I just say it's tantalizing. This whole thing's tantalizing, but it's just not tangible. Maybe we don't need to outthink it, though. The biggest winner of people buying more Windows PCs is the maker of Windows, Microsoft. The biggest winner in the data war might be Microsoft. The biggest winner in the web services war might end up being Microsoft. What else is the consumer spending on? It's hard to believe this from the pandemic, but the consumer's still traveling, going to live events, hence why Live Nation stock is soaring. As a consumer, I hate these extortion Ticketmaster fees, but as an investor, I love the business model. Consumers still spending on cruises, as we saw last night with the Norwegian Cruise Line holders. But she's not spending on herself the way she used to, except at Walmart, like I mentioned earlier, maybe Urban Outfitters, maybe some Macy's. The good news about the limited consumer spending is that we don't have to declare it static. Just like Lowe says, there will be an inflection point and the money will start going to home improvement again. Right now, though, we just don't have enough housing turnover. Mortgage rates are simply too high. The lack of existing homes on the market is at least good for builders of new homes, like we saw from Toll tonight. Once rates come down, the money flow might shift, and then things will be better. But the bottom line, right now you have to follow the money, and it's currently flowing to businesses that cater to other businesses and the ones that need to interrogate the data. The rest, not much there. Ain't got nothing for them. Let's go to Chad in Wisconsin, please. Chad.
Hey there, Jim. How you doing today?
Today's a great day. How about you?
Excellent. We're doing excellent as well.
Oh,
hey, I had a question about a group that is going to eventually compete with Chipotle. It might take a while. Right. The PE is a little high on it. I did get into it a while back, around the upper 49s. Got back out of it around the 69 mark. Kind of regretted it because now it's over 80. Wanted to know what your thoughts were on Cava Group.
Cava, I'm very bullish. I think the comparison with Chipotle is actually, and I rarely ever say this, reasonable. It's not excessive, and I think Cava is really good. All right, listen, you always have to follow the money when you're picking stocks. Right now, it's flowing to businesses that cater to data and to data, but also data. On Mad Money tonight, I'm catching up with Lowe's after this morning's report set the stock lower to see if investors are getting an opportunity to do some buying in that home improvement retailer. Then can Deere plow ahead for the long term, or was the beaten lower quarter a sign that you should take your position out the pasture? I'll give you my take. And I'm going off the tape with the CEO of 100X to learn more about how the data company is giving investors a consumer-driven angle to help make more informed investing decisions. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
What do we make of these numbers from Lowe's? This morning, the home improvement retailer reported an 11-cent earnings beat, with higher than expected sales and better than feared same-store sales. However, Lowe's merely maintained its full-year forecast, and management gave some tepid commentary about weakness in do-it-yourself home improvement projects, ones that I alluded to at the top of the show, which is ultimately why the stock tumbled almost 2%. So I got to wonder, did the market overreact to what I thought was otherwise a pretty decent quarter? Earlier today, we got a chance to dig deeper with Marvin Ellison. He's the president, chairman, and CEO of Lowe's. So take a look. Marvin, welcome back to Mad Money.
Thank you, Jim. It's great to be with you.
Now, I've got to tell you, Marvin, I got up, I get your email, and I look at things. I say, well, this stock's going to be up nicely. It is up nicely. Then it goes down. Let me tell you, I think the first reaction was right. I'll give you why. You exuded a sense of optimism and a belief about both the consumer and the, let's say, the professional that we didn't hear at a competitor. And I think that what I'm seeing is a great progression, and that eventually, when things get better, that inflection is hit. You're going to crush it. Tell me I'm wrong.
Well, Jim, that's our belief. We've been investing billions in our business so that we can not only weather the near term, but we can grow our business when the market improves. Look, for the quarter, we delivered $21 billion in sales. We grew our pro business mid-single digits. We grew our online business positive. We delivered positive comps in lawn and garden. Building materials, we reduced our inventory by $1.8 billion, generated $3.9 billion in free cash flow, and we returned $1.4 billion to our shareholders in the quarter. But more importantly, 93% of our stores, which includes all of our hourly associates in those stores, qualify for our quarterly profit-sharing bonus. So not only did we have a good quarter in a tough environment, but we rewarded the most valued associates we have, those men and women working in our stores and distribution centers. So we're not looking at the market, trying to determine our success based on how our shares trade on a daily basis. We look at the last 5 years, and we feel great about the value we return to our shareholders. We're going to continue to invest, continue to leverage our great balance sheet, and we're going to be great in a tough environment. We'll be even better when the macro turns.
Okay, well, let's go over the switch that needs to happen, the so-called inflection. Your excellent CFO, Brandon Sink, does say that, look, we're not seeing that inflection point yet. Consumers remain sidelined. Marvin, what's going to take it so that you do kick up to the next level?
Well, Jim, I think this is a product of customers and consumers just waiting to see what's going to happen next. Look, if you think about just the housing data for a second, and you think about kind of what is available, you have $33 trillion in equity available that's been accumulated, in the current state of housing. You right now have 90% of the homeowners out there that either own their homes outright or they have a fixed mortgage rate. And the average mortgage rate in the U.S. is 3.8%. and so right now, customers, have equity in their home, roughly 40% appreciated since pre-pandemic. They have low rates. They have disposable income to spend. I just think they're cautious based on the interest rate environment and the inflationary environment, and they're just waiting. So for us, Jim, we can't time the inflection point, but what we can do is invest in our business, make sure that we are ready to perform irrespective of the macro environment, but more importantly, we know that all macroeconomic cycles are cyclical. They go up and they go down, and we're preparing to be at our best when the cycle turns up, and we know that's going to happen. And when it happens, we're going to take meaningful market share based on the work and the investments we put into the business.
Well, I think this is a great point, because there's a moment in the conference call where I was concerned about directly that you addressed. I figured you've been there for 5 years. I watched what you've done, okay, for 5 years of the technology revolution. Let's put it that way. And I thought you were over. I didn't know what more you could do. And then it turns out, you had 30 years of a not great customer relationship. You've got this Lowe's Rewards. This is from March. Give us an early indication through SpringFest what what is the rewards program meant?
So for some context, Jim, and you know this, roughly 70+% of our customer base is do-it-yourself. Right. And so we're designing a loyalty and rewards program to reward these do-it-yourself customers. And so we focus in the March rollout on enrollment, on engaging active members, and driving app downloads. We've been extremely pleased with the early response. And the goal is simple. We want to drive one additional trip from our DIY customers to our stores throughout the year. That within itself, from a financial perspective, pays for this program plus, much, much more. And so the program allows, rewards members to earn points toward Lowe's money. It provides free standard shipping, other benefits and gifts. And if you are a Lowe's Rewards credit card holder, you get 5% off of purchases on a daily basis. And so, look, you and I know that data is the new currency. Right. And we want to take the data that we are accumulating with this new loyalty platform. We want to use it to create a better customer environment, both in-store and online. But we also want to personalize our offers and create an environment where these customers choose us over other competitors in the market space. So what I will tell you, it's early, and you know that reward programs are designed to accumulate information and drive, multiple trips throughout, a period of time. And we're really, really pleased with the early results. And we think this is going to pay big dividends for us over the long term.
Got to believe it. 5% off daily is not bad. Now, I know these bigger tickets, immersion, kitchen design. Previous quarter, you talked about how Vision Pro is going to help. Yes, data is the currency. And the data that comes from Vision Pro, is it working for you?
It's absolutely working. And more importantly, Jim, it's giving us the ability to attract great technology partners who want to do business with us. They want to innovate with us, and they want to be part of our strategic plan. So, Vision Pro is a great partnership. With Apple, we've had great work with NVIDIA on AI and AI technology that we're using within our store. And so we're just excited about all the possibilities that's in front of us. We have 50 plus active AI models. We have used it for sourcing logic, inventory planning, pricing. Our focus is on creating an environment that's easier to sell, shop, and work. And we're one of the first in our industry to have a custom chat GPT plugin that allows customers to get assistance with a difficult home improvement project. And they can do it online by leveraging this custom chat GPT plugin that we've developed. So there are just so many things that we're doing in addition to Vision Pro that's creating an innovative environment. And Jim, let me take you back 5 years ago. We couldn't even give customers an e-receipt.
I know.
And so, so you think about where we've come from that really what I call prehistoric time to now partnering with Apple, partnering with NVIDIA, partnering with some of the best technology minds in the world. And we're excited about what's to come. But we know that these partnerships will create incredible value and incredible differentiation over time.
All right, last question, Marvin. When I go to your store in Riverhead this weekend, because I want to get my tomato baskets, what else should I be looking at that other people are buying that I should put in my cart?
Well, Jim, I love innovation. And look, we got great innovation, and customers are still paying for innovation. We get the backdrop that discretionary DIY is down on the big ticket, and that's true. But Toro launched a Smart Store More for people in urban spaces that you don't have a lot of area to store more. You can reduce the storage space by 70% because it stands up and has proprietary, patented technology that keeps the oil from leaking. If you're an electrician and you want to have a quick water heater installed, A.O. Smith has a 120-volt plug-in water heater that goes into an outlet on the wall. I mean, Klein Tools, the #1 tool brand for electricians and HVAC professionals, have great technology. But I think for you, Jim, you're an avid gardener, and we have the best garden business, of any retailer in this space. And we've done an incredible job, not only with battery outdoor power with our partnership with Ego, but the launch of Toro in our business gave us incredible strength on battery and gas. So anything you need for your garden, whether it be plants or whether it be outdoor power equipment, we are best in class in providing that to you and to all of our avid customers that want to do work on the outside.
Well, I look forward to that and look forward to getting my 5% off. And I want to thank you very much, Marvin Ellison, President, Chairman, and CEO of Lowe's. Marvin, I love it when you come on the show. Thank you so much.
Jim, great to be with you. And look, for all of the people shopping our stores, when you see an associate wearing a camouflage vest, that reflects an associate who is either current or past military service. And so make sure you stop for Memorial Weekend, shake their hand, and thank them for their service. We have over 26,000 associates that are current or former military working for us, and we're proud to say that they're members of our team, and we're proud of the service that they gave to make this a great country.
I can't wait to say thank you to them. Marvin Ellison, thank you for coming on Mad Money.
Always great to be with you, Tim.
And Mike's back every day.
Coming up, no traction in tractors? Cramer digs into what's gone rotten with Deere. Next.
What do we do with the stock of Deere? America's #1 maker of farm equipment keeps reporting great results, and then what does it do? It slashes its full-year forecast. Last Thursday, they did it again, delivering a big top and bottom line beat. I mean, nobody really cared about it, though. Why? Because management cut their full-year forecast, causing the stock to tumble nearly 5% in response. The funny thing about Deere is that it keeps beating the estimates. 8 revenue beats in a row, 7 earnings beats in a row. But the stock's basically been going sideways for the past 3 years. Some of that's purely because we've been in an agricultural down cycle since the industry peaked in 2022. When farmers make less money on their crops, they're less likely to buy new equipment, especially when the Fed raises interest rates and the cost of financing that new equipment goes through the roof. And make no mistake, you need financing for this big stuff. Deere's largest tractors and combines can cost as much as a house. So even though this company delivered record sales and record earnings last year, even as it has an unbelievably good reputation for machinery, the stock gets no respect because everybody recognizes that the whole ag complex is headed for tougher times. Ever since the market-wide bottom last October, though, investors have been grappling with just how tough this lean period will get. It's hard to fathom because Deere keeps reporting phenomenal results while giving worse forecasts. Stock will get clobbered. Then when there might be any sign at all that the Fed might be willing to cut rates this year shows signs of life again. Plus, it didn't hurt when all sorts of crops seemed to bottom earlier this year. But then last Thursday, we got another beaten lower quarter from Deere. Even though the actual results were terrific, management slashed their earnings forecast while also cutting their sales growth outlook for the production and precision ag segment. That's been a pristine one. Previously, they said sales would be down 20% this year. Now they're saying it'll be down 20 to 25%. Even worse, Deere took its sales growth outlook for the small ag and turf business from down 10 to 15% all the way down 20 to 25%. As for the rest of the business, construction and forestry, they left the forecast unchanged, but it's still down 5 to 10%. Now, Deere also gives you an outlook for their end markets. What's frustrating is that every time they cut their guidance, it's much worse than what they see for the broader end markets. Basically, they keep telling us that they expect to do worse than the industry as a whole. Thanks for nothing. Worse, every time these guys report huge sales and earnings beat their hideous full-year forecast, make it seem like the rest of the year is going to get much uglier. On the conference call last week, Deere's Director of Investor Relations, Josh Beal, gave some color on the weird dichotomy of these repeated beat and lower quarters. He described the better-than-expected results as a function of strong execution and some good luck in the form of, for example, lower freight costs. But the overall demand environment has worsened over time. Farmer sentiment has worsened, in part because of shrinking crop margins all across the world. Used equipment inventories have been rising. That's very, very negative. And persistently high interest rates have all contributed to the weakening backdrop. Plus, Deere's getting hit particularly hard because its highest margin products and regions are experiencing some of the most significant declines. And that's why management keeps saying they expect to do worse than their end markets as these high-margin sales dry up. What do we do with this stock? What do we do with the stock of Deere now? Let's start by stating the obvious, which is that the agricultural environment, it remains fluid. How about that? But we clearly haven't reached the trough for the industry just yet. Now, as investors, we sometimes have to take a leap of faith and buy a stock before the actual business bottoms. I do that a lot for the charitable trust. I don't think we're necessarily there yet with Deere. With that caveat out of the way, I got to tell you, I am not as negative on Deere as you might think. Why is that? 3 primary reasons. First, I like how the stock's actually acted since the market bottom last October. While Deere sold off with each of the last 3 quarters, and deservedly so given its consistently ugly guidance, the stock keeps trying to go higher between those quarters. That tells me investors actually really want to own the stock of Deere. And the second we start getting incrementally more encouraging updates, this thing could make an impressive run, higher so then it'll be too late to get into if we wait. Second, we know this company's been squeezed by the downturn in agricultural commodities and the Fed's higher for a longer interest rate environment, but both of these things might be improving. crop prices have had a nice bounce over the past couple of months. Get this, wheat has quietly risen almost 35% from its mid-March lows. Corn's up more than 16% from its late February lows. Soy is up to over 10% from its February lows. I'm not ready yet to declare an ag bull market, but obviously it's good news for Deere that wheat's up 35% in the last 2 months. Meanwhile, there's been a ton of misdirection on the interest rate front. I still believe that rates are ultimately headed lower this year, especially as we keep seeing signs of economic weakness, the so-called brown shoots I talk about all the time. If I'm right, that will take care of a major headwind that's been holding Deere back. Finally, when you look at Deere's slowly eroding full-year forecast, you need to know that much of the big downturn they're projecting is actually intentional. The company recognizes it's facing a softer demand environment, so management decided to intentionally restrict its production in the back half of the year, rather than running its factories full bore. That's great, because then they won't be left holding the bag of a ton of inventory. This is something that was mentioned by several Deere executives on the conference call, including the head of the precision ag business that I care so much about, Corey Reed. He emphasized that they really don't want to create an oversupply situation like they have done in the past. Here's how I put it. I'm going to quote him. We're focused on proactive management to ensure that we keep inventories in balance with demand. This is a key component to ensuring better structural profitability through the cycle for our business. In short, Deere's trying to become less of a cyclical boom-bust business. By the way, that is something that Caterpillar has accomplished under the great Jim Umpleby. Doesn't hurt that some of their highest tech offerings are recurring revenue software products that can make money in good times and bad. Still one more example of how the company's trying to take control of its own destiny rather than staying hostage to the cycle. Of course, for the moment, Deere's still very much hostage to the ag cycle, and we're in a down cycle now. We're searching for a bottom, and it continues to be elusive, which is why the company keeps giving us these grim forecasts. Things may well get worse before they get better. But let me give you the bottom line here on a company that has been maligned by the street and by me. If you're willing to take a long-term view, I don't think you should give up on Deere here. Some of the worst headwinds that are beyond the company's control, right, beyond, well, they may soon reverse. In the meantime, management's been doing a terrific job of taking control of their own destiny. So, yes, Deere's stock has been stuck in a ditch. But I don't think you should give up on the company just yet. When things get better, and they always do for Deere, this stock could soar. Larry in Idaho. Larry, Idaho, whatever.
Booyah, Jim.
Booyah, Larry, what's up?
I own 2,000 shares of Archer. Should I stay with Archer or buy Joby?
What? No, go buy Walmart or something. Go buy a real company. I mean, we got to step up our game here, Larry. I mean, you're from Idaho. Come on, man. Don't be a potato head. I need you to think about buying something really good. And Archer and Joby aren't good. I'm coming out to Idaho, I think in June. I'm going to have to come out there to explain to you. But we're not going to be in the Archer and the Joby. We're going to be in the Walmarts and the real good ones, okay? I love you, buddy. How about Eric in Michigan? Eric.
Jim, I love the show.
Thank you, buddy. What's going on?
Jim, I'm calling on General Motors. I'm a longtime shareholder of General Motors. I've had it for about 3 years now. I've been pretty flat because I purchased in the 50s, but I also purchased in the 30s. The reason I'm calling today is I know General Motors is buying back shares, which is a positive.
Yes.
But I also know that you like Ford for the investing club, and Ford has a higher dividend. What are your thoughts of me flipping my shares of General Motors into Ford?
You know, well, look, one's in the charitable trust, one isn't. Ford is. But this GM buyback of Mary Barr's has really worked. And I think the stock's going higher. Ford, I am betting, will come to its senses and do a buyback. If it does, then you'll wish that you were in Ford stock. But right now, stick with the GM. I'm not going to urge you to sell. Thank you for being a member of the club. I think it's just a matter of time for the buyback, and I'm being paid almost 5% to get it, but I can't say swap one for the other right now. You got the one with the buyback. That's what matters. All right, Deere stock has been stuck in a ditch, but management's doing a great job of taking control of their own destiny. I don't think I would give up on this one, and if anything, next tick down, maybe do some buying. All right, much more Mad Money, including my exclusive with 100X. Can this private player's data for good business model help you get a read on companies you're eyeing for your portfolio? I'm talking to the CEO. Then Red Lobster recently filed for bankruptcy. So what was behind the restaurant chain's collapse? I'm digging into the endless shrimp and giving you my take. It ain't scampi. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. In this business, as you know from the top of the show, we're always trying to get a read on what the consumer exactly wants. Because we live in a consumer economy, 2/3 of the economy. If you can figure out what people want before they want it, well, you can get ahead of trends, and we know that's very lucrative in the market. Which brings you to a privately held company called 100X, founded a little over a decade ago by a former Goldman Sachs partner, Rob Pace. 100X sources feedback from actual customers of over 3,200 companies across more than 80 industries. They're so good at collecting and analyzing consumer data that just tonight, we learned that Goldman Sachs is going to start incorporating 100X's insights into their equity research and investment banking units, of which you know I like so much. So how does it all work? Let's go straight to the source with Rob Pace. He's the founder and CEO of 100X. To learn more, Mr. Pace, welcome to Mad Money.
Thank you.
All right, I'm going to ask the first question. How do you get your data?
100X, actually, you go all the way back to biblical times, and it's the illustration of if a farmer puts the right seed in the right soil, you can create a crop 100X.
Yes, I actually knew that. I was thinking maybe that's you guys. That's what it came from. But then I said, no one ever is spiritual in business, but you are. And you have an innovative way. And then I want to get this at the top because I think it's really important. A lot of people are very cynical. You actually have helped charity at the same time get information.
Yeah, we've given away tens of millions of dollars to charity. It's a unique model. I think we may be the only company out there who our entire cost of goods sold goes to charity. So the real question is, how do you get the normal consumer to give you the feedback on the brands they use? Because there's paid survey takers, there's loud voices on social media. So I know, having been the head of the Salvation Army at one point in my life, that we had 30 million beneficiaries just in that one charity. And every charity needs money. So basically what we did is we hit on a fundraiser that said, okay, you give us this feedback and we'll sponsor the charities.
Now, at the same time, Goldman's not a charitable endeavor, but they seem to know a good entity when they see one. So this is a very important tie-up for you.
Yeah, no, it's quite significant. So from Goldman's standpoint, they're adding the dimension of customer experience to their leading, research and investment banking, so they can advise clients. And I think that's the big theme, is customer experience and connecting it to financial outcomes.
So you may know, like we do, that, for instance, that we like Elf, and every time it's been hit, we like them. And then I saw that you have data which says that we may be right. We've been big fans of Dick's, both the previous CEO and the current one, and we've been concerned about Starbucks, where we have a charitable trust position, and it seems to be going awry. Now, those are all things that I might have been able to have a hint of by looking at your data.
Yeah, we called all of those out 6 months ago. And again, my opinion means nothing, but the crowd collectively.
Well, look, the crowd can be right, can be wrong, but if it's right a little more than it's wrong, we know what that means.
Yeah, in fact, Jim, when we see a material move in our data, we know there's a 2/3 probability that within 2 quarters that the company's going to beat or miss estimates in line with the way the crowd is guiding us. And that's why Goldman is so interested in this. It provides that forward-looking headlights for their investor clients.
Well, should I presume that many of the retailers are going to be as part of your database?
Yeah, we as you said, 2/3 of the economy.
Right.
We have 3,200 brands, but we don't just do retailers. We do financial services, airlines, healthcare. So it's the full wallet of the consumer that we track.
Now, do any of these companies not pay you to skew the data, but pay you to get the data?
Yeah, that's our business model. The way we make money is we have a syndicated data product that is used by corporate leaders, and corporate leaders need an independent view of what's really going on.
That would be you.
And that's us.
Right. I mean, we can only have so many secret customers who might tell us really what is anecdotal. We don't want anecdotal. You're anti-anecdotal.
Yeah, and we believe absolutely in the feedback of the crowd. And what we do that's different, we don't survey people, we listen to them. What I mean by that is when you sign up for a 100X program, you pick the brands. You say, this is who I care about, why they're good, why they're not good, and importantly, Jim, how much I'm going to use them in the future. And that's been what's predictive.
Well, you did something in this that's really rather remarkable. You talk about GLP-1 drugs. I have felt that Lilly is a great brand. I don't know what it is, Ozempic, Wegovy somehow, it's over there. It's over there right now. Yesterday, the FDA said you could have some, I don't know, it's like a compassionate use almost of Joe Blow's GLP-1. It sounds like brand name matters for a drug.
Yeah, so first of all, GLP-1 drugs, our data is spectacular,
really?
Up and to the right. But amongst them, best in class are the Lilly drugs. So now Zepbound, before that Mounjaro, double-digit improvement in terms of patient outcomes like lifestyle, et cetera, versus the alternative. So we had a strong point of view that they were going to emerge as the strongest player in GLP-1s. And the other issue, which I know you focused on, is what's the derivative impact?
Right.
And we're not seeing it in restaurants. We're not seeing it in snacks. We do see it in traditional ways you lose weight, right? Like traditional weight loss programs, meal kit deliveries. We see those really facing headwinds.
Well, I wish my father was still alive because he sold doggy bags to restaurants, and that's where you would see it in because they can't finish the steak. That's what's going on. Well, anyway, I want to congratulate Rob Pace. He's the founder and CEO of 100X, of which I am incredibly intrigued. Maybe I'm not allowed to trade stocks. I have to hope maybe in the goodness of heart, Goldman will show me the data. But I congratulate you on all your success.
Thank you, Jim.
Of course. Mad Money's back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the lightning round. But you played it out. And then the lightning round is over. Are you ready to keep that done? Lightning round. Let's start with Rocco in New York. Rocco.
How's it going, Jim? I'm wondering if you see growth in M&A for Q3 and Q4, and I'm wondering if you see that in the middle market, especially for companies like Lazard.
I think Lazard's a good buy here. I do believe that things are going to get a little less onerous for when it comes to takeovers. So it's a really good idea. Thank you for bringing it to our attention. Let's go to Frank in Ohio. Frank.
Hi, Jim. I had Dominion Energy in my portfolio for years, and I was losing money on it, so I sold it, and I purchased Enbridge, and I'm making money on it, so I want to hold it a long time and just keep reinvesting the dividends.
I like Enbridge. Continue to reinvest. I'm one of the few people that's like Enbridge all the way down because I trust that management team. Let's go to Ed in Florida. Ed.
Hey, Jim. What do you think about WMS, Advanced Drainage Systems?
Another incredible infrastructure play that I should have brought me so many of. PWR. There's so many good ones, and I keep trying to get them all together in one particular place, and I've not been able to do that. I've let people down. I'm going to work on this. Let's go to Clinton in Florida. Clinton.
Hey, Jim. AST Space Mobile hasn't made any money yet, not a nickel. But what do you think of its potential for
No, I want you to stay away. We got so many great companies, so many terrific companies, and we don't need to be in that one. Let's go to Ed in Florida. Ed.
Hey, Jim. New club member here. Thanks for taking my call.
Of course. How can I help?
I have a question about Zebra Technologies.
It's made it all the way back. It's made it all the way back. Hallelujah for them. I got to tell you, because I have to tell you, I've always liked those guys. I wish Honeywell would sell its ne'er-do-well division to those guys. It would be nice if antitrust would let it happen. Let's go to Mike in Pennsylvania. Mike by bike.
Hey, Jim. I'm calling about Sarepta Therapeutics, ticker symbol SRPT.
Yeah, you know what? I have not looked at lately what it's doing with RNA and some really tough diseases. It has been a company that has not made money, but is about to break out and make money. I'm not going to say no to it. Let's go to Larry in Oklahoma. Larry.
Booyah, Jim.
Nice call.
I have one question, and it's about Palantir.
Well, Palantir's got good commercial and good military. They want to emphasize the commercial. I think it's fine. When it comes to cybersecurity, I am partial to Palo Alto, even down here, down 12, and to CrowdStrike. Let's go to Brendan in New Jersey. Brendan.
Hey, Jim. Hey. So I know you have some feelings about oil, so I wanted to ask you about PBR.
Let's stick with domestic. I like Coterra best for my charitable trust. We follow that on the CNBC Investing Club, of course. That's the best one. Let's go to Barry in Florida. Barry.
Hey, Jim. Thanks for taking the call.
Yes.
I currently own a stock. I want to know buy, sell, or hold Jacob Solutions.
Yes, you want now. Jacob Solutions is, again, like the American Drainage. These are infrastructure plays. That one's doing very well. I would want to own it. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, pinching pennies. Why Red Lobster got shell-shocked. Next.
Nobody roots for a bankruptcy, especially one that stems from mismanagement. We now know the tale of Red Lobster with its all-you-can-eat shrimp promotion for $20, where it got beat endlessly by customers who fasted and then chowed down on the scampi. The ultimate endless shrimp deals should have remained an LTO, limited time option. And it was priced way too low for the giant number of servings some patrons scarfed down. Of all places, how does Red Lobster not know that people love shellfish? It was a disaster. The ultimate unforced error, frankly, it caused Red Lobster to swing to a loss of $11 million last year, what was the approximate cause of the collapse. That said, this chain with more than 580 locations has been falling apart for years. It's been through several different owners. It had no CEO for a year, and frankly, it was an accident waiting to happen ever since it was spun off by Darden a decade ago. Now, it didn't have to be this way. Those of us who've been around forever remember going to Red Lobster, and it was the best seafood place in America, with lots of all-you-can-eat shrimp deals for a limited time only, of course, and giant schooners of beer, which made the place fun and inexpensive. Once I got to meet the cool guys from the Deadliest Catch, and they said Red Lobster always took the best stuff only, but didn't pay well. Kind of what you want from the shareholder perspective. No matter, that was all ancient history. Its multiple owners, including the last one, which supplied the shrimp, seemed about as competent as I was at running Bar San Miguel before I realized, you need a professional manager at the helm. In other words, they were restaurant amateurs, just like me. The balance sheet alone was a nightmare. These guys did a ton of sale leasebacks with the real estate, the cost of labor, just killing them. And they couldn't find decent management in an environment where there's so much competition for leaders. Of course, I feel terribly about the layoffs. But the more I examine the situation, the more I realize that the consumer had nothing to do with Red Lobster's collapse. I hesitate to call it Red Lobster's demise, though, because one of their creditors is very smart. It's Fortress. So they may actually resuscitate the darn thing out of bankruptcy. Now, if you're Fed Chief Jay Powell, you might just for a moment think, oh, here it comes. The consumer's finally starting to pull back. Get ready to take an axe to rates. But Red Lobster, like Beth Miam, was not brought down by a more frugal consumer. It was a victim of its own mismanagement. Plus, the newly emptied locations will quickly be snapped up, something that the CEO of Realty Income, letter O, which did some of the sale leasebacks, told me that would happen not that long ago. Red Lobster's a top 20 client, albeit with about 1% of Realty Income's rent base, so it's not going to hurt letter O, which I like very much. Now, Red Lobster's the classic case of why I cannot expect more than one rate cut from the Fed this year. If you're going to get multiple rate cuts, you need to see some good operators struggle, not poorly run ones like these guys. You need to see one of the 4 cruise lines succumb to their massive debts. But as Norwegian made clear to me yesterday, that just isn't going to happen. For heaven's sake, you need to see some real belly-ups to slow down the hiring juggernaut, take the pressure off wages. The simple fact is that almost any Red Lobster employee who wants a job in the food service industry will most likely get one. Until we see good outfits with too much debt or okay outfits with the wrong merchandise start to go under, you can forget about the Fed riding to the rescue of the consumer, because they will never cut rates with unemployment below 4%. There's just not enough weakness in this business right now. That's incredible. And a one-off all-you-can-eat shrimp deal going bad is not going to upend the whole restaurant industry. It's just going to make Red Lobster's competitors stronger. They're about to be down a competitor with a lot of great real estate up for grabs. Good for them, not necessarily good for rates. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.